Hi, I'm very happy to be here at the conference on accountability in a sustainable world. To me, the sustainability movement doesn't become real until accountants get involved. I'm not an accountant. I'm an economist. So when I hear about some new approach to business or investing, I ask myself, what market failure does this address? I understand capitalism, philanthropy, government policy, but what is the role of this fourth thing? And I think economics has something meaningful to say. I hope it does. I'm going to suggest that it does. The sustainability or the ESG, CSR movement seems to me stems from an intuition that businesses engage in activities that may often conflict with the wider interests of society. And I think investors or creditors may want to know the extent to which firms deviate from the social optimum for two reasons. First of all, if a firm is up to some sort of mischief causing damage that it's not paying for, those being harmed might someday catch up with them and stop the harm, and or regulators may do it on behalf of people that are being harmed. So that's a risk that's lurking out there that could interfere with the company's profits or its viability. The second reason is that altruistic investors, stakeholders, might want to direct their investments to activities that influence or promote the greater good. And so how do you translate that intuition into something that's measurable or well-grounded? And, some corporate adherents align their agendas to the UN Sustainable Development Goals. Some create their own agendas, and some skip an organizing concept altogether, as far as I can tell, and frame their sustainability as kind of a collection of good deeds, from corporate philanthropy to the sale of healthy products to carbon footprint. So in the absence of a theory, I think it's very hard to know what ought to count as sustainable or not, or unsustainable. What about a firm that offers below market benefits to workers? Is that bad? Workers are accepting the job. Maybe the wage somehow compensates them, or are things that we don't observe. What about a company that produces oil drilling equipment? We need oil. Somebody's got to produce the equipment. Should we punish that activity? When it comes to measuring a company's greenhouse gas emissions, did you count the activities of the suppliers, the carbon footprint of the suppliers, such as the utility? I'm going to propose here a single unifying principle. It's a very orthodox idea from economics. And the idea is to assess accountability in terms of the economic externalities that the company creates or destroys. So together with the income statement, sustainability account should provide the information that's relevant to both those types of stakeholders, the ones that are worried about the risk or the altruistic investors that want to direct the company to more pro-social activities. And I'm going to argue that some of these externalities can be readily quantified. Maybe it's not easy, but it's not impossible. And some are very difficult to quantify, so they would have to be reported as notes. And some practices that might feel relevant to sustainability movement on the surface, such as exhausting a scarce mineral resource, consuming electricity that's been appropriately taxed, those don't belong on the list at all. Okay, so what is an externality? I'm writing a short paper that I've submitted to this journal. I hope the editors will accept it. And I discuss the nuances of different definitions in that paper. I find a mainstream definition of externality to be most appropriate for our purposes. Here, let me read this. An externality is a harmful or beneficial action taken either by a producer or a consumer which affects other producers or consumers, but is not accounted for in the market price. So action taken by consumers or producers. So that would exclude, let's say, consumer surplus. Let's say a company sells salt for $1 a pound, and consumers value that salt much more highly than the dollar that they pay. But in competitive markets, they derive more benefit from the salt than the price that they pay. It's a consumer surplus. Nothing to do with an externality. That's free markets at work, delivering an optimal allocation of resources. And there's no special accounting that's required for that, according to this theory. I say the same thing about using up, if I use up an input in my firm that drives up the price of in another industry or in a related industry, that's, I suppose, bad for my competitors or other uses of that input. That's also not an action taken, not accounted for by the market price. It doesn't count as an externality. Again, we have a large body of theory. It's one of the few and nice cases where economics has an unambiguous answer that the efficiency is properly accounted for in the marketplace. So to take the standard example of what an externality is, the iconic example is overfishing in a pool. In this example, fishermen deplete the fish population. When they just catch an extra fish, they look at their marginal effort and the value of the fish. They ignore the cost that's imposed on others. So a profit-seeking firm that owned the pond and charged the fishermen the right to fish would sell licenses up to the or charge for the right to fish and go right up to the optimal amount, where the cost, that the external cost that's imposed by each fisherman is incorporated into the price that they pay for the right to be able to fish. And you can apply this very broadly. If individuals could charge for the air that they breathe, and they could charge for the pollution that they encounter, then factories would pollute up to the optimal amount, not counting climate change and the like. If you could charge for your limited attention, you'd receive the optimal amount of spam emails and so on. So let me pause for a moment and just introduce one more term from economics, and that's the idea of a Pigovian tax. Maybe many of you already know about this. And that tax internalizes the social cost when an externality is involved and brings about the optimal allocation of resources. So in the example of the fish, if there was a tax on each fish caught, and the tax was computed to be just so that the socially optimal amount of fish were caught and the pool was set at its optimal level. So in theory, when a Pigovian tax is being charged, the result is the same as if private pond owners ran the fishing operation to maximize profits. Okay. So closer to our world of sustainability, suppose an auto manufacturer paid a per ton carbon tax. Say it's running carbon offsets are about $80. In my opinion, it should be larger. Let's say $200 a ton. But let's just assume that it accurately measured social cost. Okay. Then, if the auto manufacturer paid that tax, okay, then we wouldn't say that the company had created an externality, but instead we would accept the reported earnings as sustainable. Every time they produce the carbon, earnings go down by the right amount. You're seeing in their regular earnings, their P&L shows the true statement of what they have done for society. So if they make a profit, after being charged the Pigovian tax, the value of what they create for consumers is greater than the cost of resources that they deploy of inputs and labor, and accurately Even though they do pollute, their reported earnings show what I would call their sustainable earnings, so that no adjustment would be necessary. And if a company and let's take another example. They're not charged a tax, but this company cares about its post-sustainable earnings. And the sustainability adjustment in this case would be the Pigovian tax as if they had to pay it. Okay? So if an enlightened management says, I'm going to maximize post-sustainable earnings, and post-sustainable earnings are reported earnings minus the Pigovian tax that they might have paid, then they end up at exactly the same result as if they had been charged by government a Pigovian tax. So we end up right back at the optimal amount by considering sustainability as if it were Pigovian. Okay. To take another example, let's say a driver goes on the roads and they clog the road, they pollute the air, and each driver general isn't going to internalize this cost. So there's an externality. When I go out driving, I impose a cost on others that I ordinarily wouldn't consider. Okay. Now, once again, we can say there's, if there were a Pigovian tax, then we'd be back at the right level. But maybe there is. Drivers do pay excise tax on gasoline. It varies from state to state in the United States, but taxes all over the world on gasoline. Whether the intent of the tax is to address the externalities, or they say, it's to pay for infrastructure, sometimes what politicians say may not be what they actually mean. It's irrelevant. So it would be up to accountants to determine in a case like this. Well, maybe if a company is involved in driving, but they pay this extra tax, and that tax covers the externalities, that's high enough to capture the social cost. So, these are issues that are a bit thorny, but I think they can be tackled. Is that tax the right amount to offset the externality, and no adjustment is going to be necessary? Okay. Another hard problem, but one that I think can be addressed, is what is the externality for a company that buys inputs from a supplier if that supplier causes negative externalities itself? And the most important example is the use of electric power that's generated from fossil fuels. Okay. And I think, again, the appropriate sustainability requires looking at the facts, and it will vary from the facts on hand. And in my paper, I try to map out the different taxonomies, but it's maybe hard in a talk like this to go through them because it can get a bit complicated. But look, accountants are used to dealing with things that are very complicated and subtle. So I have confidence that it can be addressed. Okay, first, let's say that a utility pays the full Pigovian tax for some reason. Okay, if it burns coal, it's charged a lot. If it generates power from wind or solar, it pays nothing. And let's also assume that it's able to charge its customer minute by minute, so the price of electricity is lower during windstorms. In this case, the end user is charged the full social cost, so there's no need for the buyer of the electricity to have an adjustment in their sustainable account under these particular set of facts. Okay, to take one more example, let's say the buyer pays a price that does not reflect the upstream externalities. The utility pollutes, doesn't pay a tax, doesn't charge the consumer for the pollution. So here, the act of buying triggers marginal production by the seller and harm that is not accounted for in the price. Okay, so the buyer should add the seller's externality to its own sustainable account. And then the buyer, maximizing its post-sustainable income, regular income plus the sustainable adjustment, internalizes the full social cost. And there are a bunch of other issues that I think it's better to leave to the paper. Short run versus long run. To what extent would a commitment to buying low priced renewable energy stimulate renewable build out? And what if 90% of the electricity is produced by sun and wind, and the last 10% is natural gas? Well, if I go out and consume more electricity, on the margin, I create the combustion of natural gas. So maybe that should be counted as entirely as natural gas rather than the weighted average. And again, it depends on the facts, but I'll leave that for my paper. Okay. What about carbon footprint? That's a common concept that I've encountered in the ESG sustainability world. Externality, the idea of the externality will come to the rescue and tell us what to do about carbon footprint. It is not an externality in itself. Carbon footprint is meaningful for individual consumers if they want a diagnostic that they can monitor and control about their environmental impact. An example would be, let's say, this shows how poorly this concept fits businesses. Let's say a car dealer buys cars from an auto manufacturer, and an auto manufacturer buys steel from a steel company that in turn buys iron. There's carbon emitted at all four stages, probably the least by the car dealer. It would be absurd to count all the downstream carbon for the dealer. Okay. But the consumer who buys the car is responsible for all of that. They didn't buy the car, none of that would happen on the margin. And if they want to think of their lives in those terms, they ought to think of the whole chain. To take another example, a video game producer who's likely to have a low carbon footprint compared to a medical device maker. But does that really tell us anything at all? Sometimes it seems that ESG portfolios are just tilted towards tech because the idea of carbon footprint is conflated with really, I think, with externalities, which it is now. So I would propose, if we adopt the externality standard, we banish the idea that firms themselves have carbon footprint. Moving beyond the environmental impact, I think we can use externalities to shed light on all types of corporate activities, whether they need adjustments in the sustainable account. Let's consider corporate philanthropy. All right. Whether or not companies ought to do this, the fact is that a lot of them do. Okay. And let's assume that companies are exercising their duties to maximize profits so that each dollar they spend on charity raises revenues or lowers costs by more than $1. It could raise the revenues by enhancing the company's brand or lower costs by boosting employee morale and allowing the firm to pay a lower wage than it otherwise might have to. Okay. But as a byproduct of this activity, profit maximizing activity, the firm does spend money on philanthropic activities. So that's a public good. It's not accounted for on the firm's books. So in this theory, it belongs in the sustainability account. That would not apply to money that's raised externally, say, like in a corporate foundation. That's just a transfer that shouldn't be counted. I can even push the idea to think about what it means for diversity, equity, inclusion. In the abstract, if a worker values some benefit more than the cost to the firm, profit maximizing firm is incentivized to provide it. And you could make a similar remark about fostering a diverse or an inclusive work environment. So, a male-dominated firm might pay above-market wages to hire women in order to create a culture that they find more appealing. That's profit maximizing because it lets the firm tap into a more productive female labor pool at market wages down the road. It's not an externality. It's just business. But you might also identify some externalities in the DEI the efforts of that firm might inspire women to invest in human capital and seek careers in the industry at other firms. So it spills over to the other firms, leading to efficiencies that the first mover doesn't capture. And in addition, it might dismantle systemic bias that leads to a more equal and just society. And that's something that everybody values in and of itself. It's not obvious how to measure this in monetary terms and add the number to the greenhouse gas issue, but I think it can be at least addressed and could properly belong in the sustainability accounts. I think in general, consolidating sustainable accounts is not going to be practical. I mean, here's an example that shows why you wouldn't want to do it. A factory, let's say that you have a factory that pollutes and it's not charged a Pigovian tax, so there's a negative externality. Okay. Now, let's say that a profitable flower farm exists on the edge of a city. People drive by it. It creates pleasure for them. They don't capture the benefit of that pleasure. That's a positive externality. If the flower farm and the factory merge, canceling those numbers out, the positive externality and the negative externality, saying, well, this firm is socially neutral, it doesn't create the information that stakeholders want, because the factory might someday have to stop polluting or pay for its pollution. And to argue, well, we own a flower farm is not going to be very convincing to regulators. So I think they'd have to be reported separately. For many investors in this early stage of the movement, industry exclusions become an important part of their what they call their ESG activities. And I think to some extent that is connected to the idea of an externality. Someone who manufactures ozone depleting chemicals or makes anti-personnel mines or cluster munitions or nuclear weapons in bad countries, that has to produce a negative externality that investors would want to know about. Hard to quantify, but ought to be reported if they do it. But, some of the lists go on to include weapons of any sort, nuclear power, coal, leather, tobacco, alcoholic beverages. Sometimes that includes distilled spirits are excluded, but not wine and beer. Some people exclude. You could even argue, okay, distilled spirits might lead to drunk driving or to a degenerate lifestyle that harms family members or drains society's safety net. But, alcohol is already heavily taxed in most countries, presumably with such factors in mind. Moreover, I think society, using whatever governance methods that it deems legitimate, is already judged in most Western countries. Alcoholic beverages are permitted over a certain age, but not while driving. Casino gambling is permitted, but highly regulated. I think one could argue that society's got all that wrong, but I think it's kind of inappropriate for the sustainability account. So just to take one more minute to summarize the main points of what I call sustainability as an externality, an accounting manifesto. I want to propose an overarching organizing device that will tell us what to measure, how to quantify it to the extent that it can be quantified, and claim that it conforms to our intuition about why stakeholders want more comprehensive information than the financial statements might provide. It can give us a rigorous approach to accounting for upstream externalities, such as the greenhouse gases that are emitted by utilities. I say that standards ought to be established independently by accountants, not self-reported by firms, because for obvious reasons, there's a lot of leeway if firms are left to themselves, just like if they got to report their own earnings without anyone by themselves. So I will claim that some things might look and feel like externalities, but they're not, using generating consumer surplus, using up scarce inputs, or polluting when regulators charge an appropriate tax. And these might be genuine externalities that deserve an adjustment in the sustainability accounts. Untaxed polluting at the level of the firm, corporate philanthropy, and industry exclusions like cluster munitions. And I think they need to be reported that, some of them can be quantified and aggregated, like the impacts of pollution based on the facts at hand. Some have to be reported separately, so there'll be several different measures. But we have lots of different measures of earnings: pre-tax, after-tax, operating earnings, and so forth. So I don't think that should be too much for the stakeholders, to the consumers of these reports, to be able to digest. Okay, so that's my talk. So thank you very much. It's just really a pleasure to be with you here.